makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. G7 finance ministers and central bank governors are on the Italian resort of Stresa for their annual meeting. The agenda includes support for Ukraine and how to use frozen Russian assets. Now, traders push back at U.S. rate cut expectations to later in the year after strong economic data. We discussed with the chief investment officer of UBS Wealth Management. Plus, Bloomberg understands that SpaceX is planning to sell shares that could value Elon Musk's company at roughly $200 billion. Now, also later in the show, our exclusive conversation with Taimur Hyat, the chief operating officer of PGIM, which has more than $1 trillion in assets under management. So, U.S. PMI data for May in both services and manufacturing surprised to the upside. Now, the strong prints have spurred bets on the Fed holding gates until December. Well, I'm delighted to be joined by Mark Haefele. He's Chief Investment Officer for Global Wealth Management at UBS. Mark, so good to speak to you. I mean, today's the day where G7 finance ministers meet in Stresa with a beautiful background to talk whether the strength of the U.S. economy can, continue. Is it durable and stable?
Yeah, and look, I think that we see a picture where there's a soft landing in the United States, but the important thing there is there's still a landing. We think that U.S. inflation is going to come down like we see it coming down in Europe, and that's a good backdrop for both stocks and bonds into the second half of the year.
So what does that mean, Mark, for, amongst the G7 countries, Eurozone and ECB is probably the first one to cut. We'll see if we have confirmation of that June 6th. But what does that mean for actually portfolio building?
Well, I think that, people are getting a little lost in some of the details about, the Fed minutes and longer-term questions that both the U.S. and Europe are facing about how changing demographics and a service economy might lead to, rates not going back to zero again, like they did before the pandemic. But in terms of portfolio construction, I think there's a couple things that people should think about here. First, with both stocks and bonds looking attractive, you want to get that asset allocation in play. I think second, if rates come down, a lot of our clients are holding a lot of cash, and so they need to think about getting out of some of that cash and into some of these allocations. And then there's also a question, we think that around the U.S. election and all the other things going on in the world, there's probably going to be some volatility. So are there ways you can use that volatility to use some structures or things? Volatility is very low now, to prepare yourself for potentially higher volatility in the back half of the year.
So is the AI growth still intact, Mark? I know, it's for me a little bit uneasy at times reading that actually it's NVIDIA that frankly moves like hundreds of trillions of dollars because it props up or it makes the whole market fall. But how do you feel about it?
Yeah, well, within the equity allocation, I think we're seeing some positive trends. We've been overweight AI. We think, we've been saying this is certainly a real trend. And we were heartened to see in the this earnings period just how much the CapEx exposure to AI has been increasing. And so we think that the trend can continue. I mean, the phenomenal revenue growth, something like 262% year over year for NVIDIA, is astounding. But the trends there for AI and that bottleneck around chips seems like it's going to continue for some time. At the same time, it's good to note that the equity rally has broadened out, both away from tech, but also globally.
So where are you expecting the biggest gains to be from now until the end of the year? First of all, I mean, if equities are supported, again, is it across the world? Do you look at sectors or do you look at regions?
I think that it's a little bit thematic, the way that we're looking at it. So certainly tech is one area. But another area where we see gains is kind of the feeding the power and the infrastructure around this AI revolution, and that leads us to things like commodities. And so we actually are overweight in the UK, where valuations are attractive, the economy is improving, and you get some of this exposure to commodities and infrastructure that we like.
What's your take on elections, Mark? I know that there's many elections. I mean, the U.S. election will have implications for foreign policy, for allies, for regulation, for banks, for a little bit of everything. So, you know, are the policies clear, or are we wait and see?
Yeah, I think that, for a lot of our clients, they need to take a little bit of a step back and realize that probably the most important thing is the composition of Congress in relation to the president, and that's not necessarily known yet. But broadly speaking, elections, while we follow them in the headlines, they don't necessarily have such an impact on the portfolios. All of that said, there would be a difference, we think, in terms of the sectors and some aspects of the trade policy, depending on how the president and the Congress shakes out. It's probably a little too early to tilt your portfolio on that, if it's ever a good idea to tilt your portfolio on that. But these kind of questions are one of the reasons we see that volatility picking up in the second half of the year.
I know you like actually U.S. small caps within your asset allocation. Again, does that change on who gets into the White House?
I don't think that changes right away based on who gets into the White House. The idea of small caps is, in our base case, rates are going to fall, and that will hopefully answer some of these questions that have been dogging the small caps around how are they going to refinance and other things. Now, certainly, there are questions around where the infrastructure spending that is going on in the United States goes to, which states, which industries. So all of that can impact small caps as well. But if the economic strength continues and the rates begin to fall, that's a very good backdrop for some of this disparity between the large and small caps to close.
Mark, talking of election, it was also a big week here in the UK with the Prime Minister calling for that election on July the 4th. I know you also see value in UK stocks. Again, do you make a difference between the big companies or the small caps?
Yeah, I think we're much more interested in the larger companies that have the more global exposure. I don't think that the election in the UK, I mean, certainly if we had a surprise, on July 4th, that might change things a little bit. But the desire to have an election, the date of that, I don't think that's going to change anything about our views on being overweight the UK right now.
What do you do? I know you like fixed income as one of your preferred asset classes, Mark. What do you do with currencies? Again, dollar strength for a while put a lot of pressure on a lot of emerging markets.
Yeah, I think that we expect if people start to price in the Fed lowering rates as we expect, that could take some of the edge off the dollar strength, especially before the election. How much dollar weakness we're going to see given the global turmoil, and right now betting markets and the polls are looking towards a Trump presidency, which often has a lot of headline-grabbing news that might be strong for the dollar again. So there's questions around that. But when we look at currencies right now, I think one of the things we're seeing is that the Swiss franc has really been a currency that people have funded out of, and we think that some of that is overdone, and so we're neutral now on the Swiss franc. And we still like the Aussie dollar. We think that's going to be one of the last central banks that will cut, and it's got that commodity exposure that we like. Mark,
thank you, as always, for joining us. That was Mark Haefele, the Chief Investment Officer for Global Wealth Management at UBS. So we were just talking about it. G7 finance ministers are gathering in Italy, where a two-speed global economy is overshadowing this week's meeting. Now, officials are confronting the prospect of less synchronized monetary policies amid a resilient U.S. economy, but also tepid growth in Europe, colored by nearby geopolitical tensions. Now, let's bring in our correspondent, Oliver Crook, who's in Italy, I would say, with a pretty ugly background. Ollie, so what's topping the agenda right now?
Yeah, Francine, as you say, the kind of mood music in the background is this sort of question about sort of the bifurcation in the sort of the growth, but also within the global economy. But in terms of the deliverables of what the finance ministers of the G7 want to take away from this meeting in Stresa, Italy, it is really to find a plan for those Russian assets, how to get the financing for the war in Ukraine on stable footing, not just through this year, but through next year. And of course, the initial debate for the United States was to take the underlying assets. The Europeans said, that's a little bit too rich for us. We need to find another alternative. So they've suggested the windfall assets and really cutting a check today of a very large sum of up to $50 billion in order that are based on the sort of future earnings of those Russian assets. That is one way of doing it. There are some technical issues, and that is really what these guys are here to resolve now, so that they can be in front of the G7 leaders meeting in 3 weeks' time, that they can have a sign-off to really get that funding under sound footing. The other question and the other elephant in the room is China, the trade practices. And we've been hearing about it from Janet Yellen yesterday, and we just heard from Bruno Le Maire just a few minutes ago. Have a listen to what he had to say.
We should definitely avoid any kind of trade war, because a trade war is neither in the interest of the US, nor China, nor Europe, nor any country in the world. But nevertheless, we have an issue with the unfair trade practices, with the high level of subsidies, and with the industrial overcapacities. I'm the Minister of Finance. I'm also the Minister in charge of economy. And I will spare no effort to defend our industrial interests.
And so while China was not an explicit topic going into this meeting a few weeks ago, obviously it is also going to dominate the conversation. Can the G7 get a unified message, particularly vis-a-vis China and its trade practices?
Ollie, thanks so much. Oliver Crook there in Stresa, Italy, for the G7 finance ministers. Now, plenty more interviews from the G7 today, including Paolo Gentiloni, the European Economy Commissioner. Plus, we also have an exclusive conversation with Joachim Nagel, the Bundesbank president. Coming up, we're talking private markets with Mathieu Chabran, the founder of global alternative asset manager Tikehau Capital. That's next, and this is Bloomberg. Private credit. Well, credit bulls say corporate bonds hold the biggest edge over stocks in years. According to data compiled by Bloomberg, credit is trading at the biggest value gap with U.S. equities in more than 20 years. Now, for Europe, the same measure actually goes back at least a decade. It's a trend that's breathing new life into the conviction of credit investors. Now, let's discuss all of this with Mathieu Chabran. He's co-founder of asset management and investment firm Tikehau Capital. Thank you, Mathieu, first of all, for being here, and welcome to London. You also celebrated 20 years of Tikehau, so congratulations on that. Every conversation I have, be it with Goldman, JP Morgan, and anyone in between, is credit, private credit. Is there a danger that this gets overheated?
No, I don't think so, Francine. I mean, first of all, thanks for having me. You know, credit is the driving force of any economy, right? And there's been having these past 10 years way too much liquidity that was probably mispriced. And so if today people are excited about credit, it's because you can at least, now eventually get the proper risk premium, for this type of investment. The compounding effect of credit, which is the basis of this strategy, is what investors are looking for, globally. So I'm not surprised that bank, insurance companies, sovereign wealth funds look into that. I'm part of the skeptical about the bubble, or saying, either too much money chasing too few deals. So I still believe it's a great asset class to invest in. Yeah,
and there's a lot. I mean, I guess, the pros is that it is a new asset class. There's still quite a lot of value to be made. Again, valuations, people have concerns about valuations. And again, as you mentioned, liquidity. Are there parts of private credit that you worry about in terms of valuations?
It's very interesting you bring up, liquidity, because the public credit market have been extremely active, but with a huge dispersion. I mean, we are today in the situation of a K curve. If you're, even in the high yield space, like a double B, you're trading pretty tight. But if you're a triple C, you've never been that wide, actually wider than what it was during COVID. And for me, that is the illustration of the liquidity being constrained, obviously chasing certain assets. And that's where the opportunity is, right? Because not everything is going to go default, right? It's not going to go bankrupt everywhere. And so this dispersion is what is creating a great opportunity for private credit and many people looking into it.
But Mathieu, I think if we probably take a breather, so there is, the inflation environment has changed significantly. It's gone really rapidly. I don't know whether we've seen the pitfalls from that. But also the cost of credit and the cost of money in general, almost for structural reason, has gone up.
Yeah, no, I mean, for good reasons, because, if we, 1 second, on the inflation, as far as we are concerned, at Tikehau, we believe that effectively this sticky inflation is here to last. And when people think that, short-term interest rates are too high, relative to the long-term, we would go the other way around. Maybe the long-term interest rates are still actually, too low. So once you factor that in, effectively, and back to your question, on the credit spread and the cost of money, it's absolutely fair that today you have these type, of spread and pricing. And effectively, if it costs now your LIBOR, SOFR, LIBOR plus 400, 500, 600 in certain instances, from an investor standpoint, that's one of the best, value proposal you can have.
So where do you see the best clients and the best deals? You're based in New York. Your co-founder is actually based in Paris. What we're being debated today also at the G7 is the fact that how much does growth, stay in the U.S. and for how long compared to a weaker Europe?
Well, there is first, a structural opportunity that goes beyond, the geographies, which is providing this liquidity. Once again, the liquidity has been drying up, the central banks have been, retrenching, and the remaining liquidity has been chasing the same assets, right? So those large cap, effectively some high-grade credit, and it leaves, some whole part of the market with a much thinner liquidity actually than pre-COVID, and that's where the opportunity is. And that's a global comment, and it's true in credit, obviously, in real estate, in secondary private credit, which is an asset class that has been developing, significantly in the private markets. Now, when it comes to Europe and the US, obviously the decorrelation, is increasing, living over there. And there were, some headlines, on your program earlier on today. I mean, effectively in the US, I don't see a cooling, in prices, in inflation. It's a fully levered economy. So it's functioning, rather differently than here. In Europe, you have to be local. You know that better than anyone else. Doing business in Milan is not the same thing as Frankfurt, Paris, or Madrid. And that's where the opportunity lies for people like Tikehau.
So what does it mean for Tikehau in terms of expansion? I know you had been working on different deals. Where do you see the biggest growth for the next? I'm not going to ask you 20 years because a lot can happen in 20 years, but maybe next 5 years.
Well, 20 years goes by, pretty quickly. I've just experienced that. But the first geographical expansion has been really east. So, we've been in Asia for some time. So, we made some big announcements earlier this year in private credit, as a matter of fact, in Southeast Asia. We also expanded into the Middle East operationally, in Israel, in Abu Dhabi more recently, some further plans, to expand into the kingdom, in Riyadh, because obviously the investors and the asset owner over there, that's what they're looking for, platforms to deploy in the credit space, in anything that is yieldy. So credit, real estate, infrastructure. So that's where we see, the extension, short term.
I mean, real estate, again, we've been talking about a bubble bursting for the last 18 months. Is that working its way through? Is it a good opportunity to buy maybe some of, the lower valuations of real estate, or how do you see that developing?
Absolutely. We like this dislocation because this is when supply-demand is such an imbalance that it creates, the buying opportunity. And when you've got, the same people selling, and you saw some headlines, yesterday again, on some open-ended funds, most of the time, in my experience, and unfortunately now, it starts, getting richer, every year, you don't die because of your assets. You die because of your liabilities. And I think the mismatch that we've been seeing in some illiquid assets, and real estate being, probably the most illiquid of them all, no, you cannot have a daily liquidity on these type of assets. So once you've got this supply-demand imbalance, these flows, contrarian flows, that's where we step in and make, good investments.
So interesting. Mathieu, thank you so much for coming on.
Thank you, Francine.
Don't be a stranger. Come back very soon when you're in London. Mathieu Chabran there, Tikehau Capital's co-founder. Plenty more to come. This is Bloomberg.
South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
If there's a rate cut, fine. If there's not, then it's the question of how companies then react to that. How do they then build their businesses to exist in a rate environment which is higher than it has been the last 15 years, but I would argue that the last 15 years have been an abnormal rate environment.
Well, that was HSBC U.S. and America's Chief Executive Officer Michael Roberts with Bloomberg's Manus Cranny. Coming up, our exclusive conversation with Taimur Hyat, the Chief Operating Officer of PGIM. We're talking bonds, energy, and much more. This is Bloomberg. G7 finance ministers and central bank governors are in the Italian resort of Stresa for their annual meeting. Now, the agenda includes support for Ukraine and how to use frozen Russian assets. Traders push back U.S. rate cut expectations to later in the year after strong economic data. Plus, Bloomberg understands that SpaceX is planning to sell shares that could value Elon Musk's company at roughly $200 billion. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, stagnant living standards will likely impact Prime Minister Rishi Sunak's chances of re-election when the UK goes to the polls on July the 4th. Inflation, of course, a big part of the problem, but there's a deeper structural issue, and that is weak productivity. Now, we have a full analysis from, of course, our team on the ground here in London. So for more on all of this, we're joined by Bloomberg's Phil Aldrich. Phil, I've been dying to speak to you all week because it's been a big week in UK politics, but also a big week to try and understand whether the economy is in the Prime Minister's favor or not. Why do you think he called an election on July the 4th?
Yeah, that's the big question. A lot of nobody quite understands why. There's a theory, so you can think of it in two ways possibly. He wants to avoid negatives. So there are issues like potential MP exodus, so more defections, and he can be seen like he's clinging on to the post, and then he effectively gets forced into an election. It just looks very weak. So you get on the front foot, and then there are the possible positives, such as that he's obviously trying to get the Rwanda boat scheme to be a key thing in the election, and he. Reform, who are the right-wing party that is threatening to steal a lot of seats. He can marginalise them by going a bit early, and at the same time make the boats issue, this Rwanda policy, an issue which could bring the right wing that would vote for reform back onto his side. The economy is recovering, so as the sun comes out, there might be sort of better weather in the economy as well. He may have been hoping for rate cuts. It's now looking increasingly unlikely that those rate cuts would come as early as June, so August or maybe later. So the feeling, the feel-good factor that Hunt, the Chancellor, has been talking about will be too late, really, for people to acknowledge. And things like tax cuts, that he's already done 20 billion of tax cuts, and they got no help in the polls. The polls did not bounce for them. So it's like, if they want to do another fiscal event, what's the point? Because it doesn't seem to be working. So, all those factors may have just coalesced into sort of convincing him that might as well just go now. But yeah, it's a bit of a surprise.
But, I guess there's the Tories are so far behind in the polls. I don't know whether it's more about understanding some of the Labour policies, and they don't have to do much. You were saying this to actually win this at this point, unless there's like a huge upset. And so it's not, it's an election to try and understand, I guess, what Labour policies mean for the economy more.
Yeah, well, we should be getting, both manifestos should be out in the next couple of weeks, and we'll get a clearer idea. But the idea that Labour is going to come up with a radical set of policies that they haven't already prepared business and the markets for seems for the birds. Bizarrely, the positions of the parties are effectively reversed here, because the government would normally be going in on the front foot, but here the government is the underdog, and the Labour Party are the next government-elect, more or less. So they just need to be stable. They don't need to rock the boat. In a way, it's up to Rishi and his team to sort of come up with the radical vision and actually convince people that they're... And, of course, that's not what they're doing. They're saying we need to be we're the stable ones, but Labour are also... I mean, their whole policy is effectively, in many ways, very similar to the Tory stability policy. And so I don't think they won't want to scare people into voting for the Tories instead of Labour.
So, Phil, this is really complicated for the Bank of England, or maybe more complicated for the traders, because they have this self-imposed purdah, essentially, right?
Yeah.
So we're not going to hear from BOE officials until the election. And I don't, what does that... If you're a trader and trying to understand when the cut is coming, this is not going to be great for them.
Yeah, there'll be less... I mean, actually, some people might say it's better. There's less confusing signals. But fewer confusing signals. But we're not going to... The Bank of England it doesn't have to apply the purdah rules that apply to other civil servants, but, I mean, it's very sensible and they do apply them. So they won't be making public statements, but there will be business as usual. So we will still get the MPC minutes. Yeah. So if there is changes in language on June 20th, we'll see that. And then there's the financial stability report will happen, but there won't be a press conference. So it's these kind of public appearances and public statements that are going to be missing. But I think
it'll be interesting for the markets to see.
Yes,
I mean,
do they prefer it when the bank policymakers are quiet or when they're actually talking a lot? We'll see.
Yeah, this is so Italian. Take a day off, take a month off, guys, because there's nothing to do if you're on a trading floor, on some of the FX trading floors. Phil, thank you so much. Phil Aldrich, they're a senior reporter on the UK economy, who also recently actually won an award. So congratulations to you and the team for that, Phil. Now, European NATO members are racing to bulk up their militaries in the face of Russian aggression and the possibility that Donald Trump, if elected in November, may try to reduce American involvement. Experts say NATO nations and their allies may need to at least double their defense spending to deter any potential Kremlin threat.
This is NATO's eastern line of defense. Tensions are running high, and here in the Baltic states, the military alliance is building an advanced presence to counter one country.
Russia have the intention to trust NATO, and it's a question how much opportunities we will give them.
While troops on the ground are a big statement, there is a number behind the scenes that's far more significant.
2%. 2%.
That's the share of their economic output that NATO members committed to spend on defense. But for a while, countries didn't get anywhere near that number. And under multiple administrations, the U.S. hasn't been happy about it.
They said, well, if we don't pay, are you still going to protect us? I said, absolutely not.
The threat from Russia means that is starting to change.
We have no time. We have to be prepared as fast as possible.
Now, some are asking if 2% is even enough.
Was a Bloomberg mini-doc on the issues faced by NATO with the war in Ukraine and potential political change in the U.S. Coming up, we talk to the PGIM COO on investing in the green transition and why he's excited about avoiding the hype. This is Bloomberg. Now the conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in London. Now, the energy transition has created an array of attractive investment opportunities. Now, our next guest is most excited about, quote, avoiding the hype, which is all the title about, well, on the research paper he's just co-authored. Well, Taimur Hyat is Chief Operating Officer at PGIM, which has more than $1 trillion in assets under management. Taimur, as always, thank you so much for joining us. I mean, this is a beautiful piece of research, and it's basically avoiding the hype on both sides, like not being in the portfolios or the companies where everyone wants to be in, but also not believing this hype of diversity and actually the energy transition is over. So what opportunities do you see in this space?
Yeah, it's, energy was always complicated, Francine, because you sort of have to balance affordability and reliability and clean energy. And that just has become much more complex for investors these days because you've got, all the post-COVID supply chain issues, you've got two wars, you've got inflation raging, and sort of energy sort of underpins all of that. And when we looked at that landscape, there are an array of attractive investment opportunities, and they're across both the green energy side, but also kind of the brown villains have probably been caricatured. I think in this transition world, there are opportunities on both sides. But what really struck me was just the number of ideas which are great for governments to invest in, great for researchers and academics to look at, but probably not yet ready for investors, and yet there's a lot of hype about them. And that includes things like hydrogen and carbon capture and nuclear fusion. I think for a variety of reasons, getting to an investable opportunity for private sector investors is either too distant, too uneconomic, or just politically ultimately will be unfeasible.
But are we underestimating actually the pace at which the transition is already happening? So a lot of, if you speak to a lot of the oil majors or the mining companies, they say, look, we're not ready for the transition because we haven't mined enough of the copper, of the things that we need for the transition. Again, is it delayed or is it still going ahead but just at a slower pace?
I think just the sort of unpleasant or inevitable arithmetic of global demand for energy, with 80% still being fossil fuel driven, means that for the next 3-4 decades, I'm afraid well beyond some of our net zero goals, we will have a reliance on fossil fuels. So again, this idea of kind of, green heroes, brown villains needs to be more nuanced by investors. And, there's still tons of opportunity on the green side because that transition is inevitable, has to happen and is happening and has been happening for 20 years. And I think we'd say there it's a little bit like the picks and shovels versus the gold. We see the opportunity in renewables a little bit more on the infrastructure side and the kind of underlying pieces that you need rather than in solar or wind itself, which I think is a little overpriced at the moment.
There's a market obsession with, of course, what the Fed does and also this differentiation between, the ECB and the Fed and the fact that the cuts are delayed there. What does this all mean for debt financing? Where do you see it more attractive for the green transition?
I think actually debt financing, particularly just given the level of competition in the renewables world, particularly in the EU and US, is the way to play many of this. Okay. Because you've got the Fed pressures, but you've also got banks receding from the middle market in both Europe and the US. So actually we found far more attractive opportunities in, say, copper miners or copper companies, in solar and wind, and increasingly in hydrothermal in Latin America. And everybody forgets emerging markets. I mean, India is the 3rd largest renewable producer, but there's massive additional demand. So there are renewable opportunities there. Those are probably more in equity, but in many other places, the right way to play this is in debt with very solid cash flows, incumbent advantage, rather than the equity space, which I think has got crowded and spreads have compressed.
So when you look at solar and wind, mainly in Europe, some of the on the debt side, or also in the US?
Solar and wind with regulatory subsidies and competitive pressures, definitely not on the equity side, on the debt side. Hydrothermal in Latin America, and then things like wind turbines and underpinning all this, whatever the source of electricity, whether it's nuclear, renewables, carbon, you've got the transmission lines and the grids and the sub-transistors and the copper cables. All that is ripe for investors. And I think sort of back to basics versus getting too attracted to the hype where there's just not an economic opportunity is the way to participate and support the transition.
Taimur, I mean, we talk a lot about India, having its decade now because of some of the also, I guess, red tape being taken out, infrastructure really going in, and some of the big changes. When is the right time, though, to get in for some of these projects?
I think the right time is now. There's a 3rd largest producer already of renewables. Probably the pressure, coal is one of those elements of any investor's portfolio where there is obsolescence risk. India is one of the biggest coal producers. So that transition is happening now. I think the Indian government is very supportive of that transition. So that sort of intersection, Francine, of renewables and technology and building out this grid to allow these intermittent power sources to become much more central to India is a now opportunity rather than 5 years from now.
Is it difficult to know what section of the grid you want to be invested in, right? We're talking about it's modernization of infrastructure. It's also storage, I guess, batteries. For a country like India, where do you play?
Yeah, we are a little less bullish on the storage and batteries play. I think lithium has a huge China risk and China component to it, and sodium batteries are still a way off. I think it's the grid itself. It's the transmission companies, the sub-transition companies. I think those vary less on what kind of renewable energy you're using. Typically, we also like to come in at the level of the parent company. So we're not necessarily financing a particular project, coming at the parent company, and we'd prefer to be on transmission lines that are closer to consumer centers, rather than there's lots of risk of building millions of miles of cables before you get the opportunity.
Taimur, you also talk about leaning into lower carbon fossil fuels while avoiding obsolescence risk. I mean, low carbon fossil fuel, I guess, as an investor, it kind of gets bundled into one. So again, how do you rip out the bad stuff to keep the good stuff?
Yeah, there are probably two sides to that question. We should come back to big oil and, how should both ESG and other investors think about it. But our particular play within low-carbon fossil fuel is in, liquefied natural gas and LNG. And they're both small gas producers and large LNG producers who create the pressurization and the transmission and storage of LNG, which we think is still an untapped opportunity. And that's both on the equity and the debt side. And then I always... you can probably divide big oil between the BPs and the Shells who made more investment in LNG and have a bunch of patents on the renewable side versus, say, the Chevrons or the Exxons who've done less of that investment. But ultimately, I think all of them will become buyers of renewable technology created by smaller companies or by governments. The scalability and institutionalization of renewables requires big oil to participate in it. And I think they're going to be willing players. So you can't take your eye off them, you can't divest from them. I think engaging with them is critical.
And Taimur, I mean, given this in the kind of general context of, the cost of credit, cost of money going up, many questions about what the Fed does this year, where does it sit? Like, how much in terms of investment strategy are you looking at right now that could be volatile, a little bit like last year?
Yeah, I think investors are still very much in a sort of defensive crouch mode, Francine, and I think rightly so. The level of uncertainty, both geopolitical, with 60 major elections around the world, and with the amount of returns they can get in the short end of the yield curve at the moment, they're just kind of riding that wave. And I think whereas for a while we thought that just the stabilization of rates, which I think has happened in the EU, UK, US already, would get investors coming back, I think our view now, and as I talk to clients, is very much they want to see actual concrete evidence of rate declines. And I think we will get in the second half of this year, say in the US, at least two rate cuts. They're waiting for that. But I think there's going to be a major money in motion event for bonds when that happens, both because the yields are so attractive now after that kind of 10-year period of almost zero yields. And you obviously have the market upside over the long term as rates come down, which I think they inevitably will. Recession risk in Europe is only going up, not down. So I think that might be the first penny to drop in terms of rate declines.
But, so you're talking about a major event when the first cut happens. Are we underestimating that we could be in a different cycle? So even once the Fed cuts, it's not necessarily they cut almost at every meeting.
I think there are going to be less rate cuts, and the pace of rate cuts is going to be slower than the market thinks. And I think there are probably attractive opportunities right now, just given the yield. So we like the top end of structured products. We think kind of short-term investment grade is a good opportunity. But when that rate cycle begins, and I think in the US, the underlying economy is still strong enough that we're not talking about a deep recession risk. I think a lot more money is going to participate in that kind of gradual market upside in addition to the yields.
And do you think, Taimur, this is money that used to be on the sidelines? So is it cash?
This is money that has moved in a massive way into cash and money markets. And we see that in all the data. It's kind of sitting there. I don't think 3 years from now, even 2 years from now, I suspect not even 8 months from now, will all that be sitting in cash. It's going to move, and it's going to move first into bonds and then ultimately probably back into private markets.
When the ECB cuts, we expect June, is some of that money coming in already there, or are they waiting for the US?
I think when the ECB cuts that money, we're already seeing it trickling in. I think it's just going to turn into a flood when all the central banks are in the same direction.
All right, Taimur, it's great to speak to you again. Thank you so much for coming in. Taimur Hyat there, the Chief Operating Officer at PGIM. Coming up, SpaceX could sell shares that would see the company's valuation take off. Well, more details next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that Elon Musk's SpaceX is planning to sell existing shares at a price that values the company at roughly $200 billion. Now, let's bring in Bloomberg's Craig Trudell, who follows Elon Musk very closely. So, Craig, I don't know whether this is an Elon Musk story, because if he gets $200 billion in terms of valuation for that, he has a lot more freedom for investments, or whether it's more of a space conversation.
Yeah, I think it's honestly a conversation about, really SpaceX's very interesting approach to, being private and wanting to stay private. And it goes back for me to, the very public way in which, Musk flirted with the idea of taking Tesla off the market and of course, struggled to do so. But with SpaceX, they've done this somewhat routinely, really just offering employees and investors a chance to get some liquidity. And, it's really, I do think that all of these tender offers that we see from this company that have, become something of routine at this point just speaks to this idea that there is, appetite and demand to invest with this guy, even as he struggles with some of his other enterprises, after his challenges with, Twitter, now X, his recent issues with Tesla, that hasn't hurt, appetite for whether it's, SpaceX or, XAI, which he's been out raising money for recently as well.
But, Greg, and again, you understand, the intricacies of Elon Musk and the relationship he has with investors. If you're, participating in this tender offer, is this something, are you buying into Elon Musk with, I guess, all the question marks that could entail? Or, again, is it a space play? I don't know whether his personality is questioned sometimes in his decision-making at Tesla also translates to SpaceX.
I think there is, there is definitely, differing motivations between, whether or not you want to get behind SpaceX or an XAI. I think, there's nothing hotter right now than artificial intelligence, and it doesn't particularly surprise me to see him be able to go out and raise quite a bit of money at a pretty rich valuation for what is still a very new company. But with SpaceX, this is a very established company at this point that really has built one of the more attractive businesses in all of this sort of universe in terms of space. They really have a dominant position in terms of launch. The Starlink business has, of course, really become, a prominent player. And, I do think that, if you're going to invest in this, realm, this is, kind of one of the hottest companies around. And so, there are questions, I think, of whether or not, the valuation is maybe a bit rich. But if you can get behind this company, you become a sort of friend of Elon's.
Craig, thank you so much. Of course, Craig Trudell there with the very latest on SpaceX and Elon Musk. Coming up, Bloomberg Brief, Danny Berger and Manish Krani in New York, and this is Bloomberg.